Good afternoon. My colleagues and I remain focused on keeping consumers informed on the latest industry news that will influence their decisions to borrow, buy, and build real estate. We received word moments ago that the Fed left short term interest rates unchanged for the 10th consecutive month, and here to provide you with the what's up with the what's up via the mortgage market. It's imperative that you understand that when the Fed holds, increases, or decreases short term interest rates to the benchmark rate, does not always move home loan rates in lockstep. Mortgages are 15 and 30-year instruments and are inflationary sensitive. Regardless of any direct change with the Fed funds rate, the statement released by the Fed, the forecast on short term policy, and the commitment to the balance sheet will impact daily market rates. In summary, the Fed's move to leave interest rates unchanged was no surprise as the odds reflected. Today's statement on inflation included that in recent months, there's been a lack of further progress on the committee's 2% inflation objective. However, the Fed reiterated that it was unlikely the next move would be a rate hike. Restrictive policy will continue as long as supported by the data, while slowing the pace of the balance sheet runoff starting in June. The Treasury runoff cap will remain at $25 billion and keep mortgage-backed securities at $35 billion. The decision improved bonds, and many mortgage lenders were able to adjust mortgage rates slightly lower from the morning and yesterday. Home equity lines of credit will remain the same until next month when the Fed meets again. Currently, there's more than a 90% chance that the Fed leaves short-term interest rates the same in June, and more than 70% chance rates are left unchanged for the July meeting. Therefore, do not expect any rate improvement on any existing home equity line of credit that is prime-based, as that index will remain at 8.5% until further notice. We view the Fed's progress towards a dual mandate as a conundrum. While they've appeared to achieve terminal velocity with the labor market, the unemployment rate currently sits less than 4% for an extended period of time outside of the pandemic. Meanwhile, inflation remains sticky, and regardless, the consumer continues to spend in the face of higher borrowing costs and prices. On one side, it's a relief that the Fed does not consider it likely they will raise interest rates anytime soon. Metrics like the CPI and CPE conflict with short-term policy being restrictive enough. With rates unchanged for the 10th consecutive month, the Fed's key rate and mortgage rates remain at 23-year highs. The other half of the dual mandate, price stability, is a considerable challenge for the housing market. February housing data confirmed by the FHFA and Case-Shiller posted strong yearly price growth of 7 and 7.3% respectively. Markets across the board are performing at consistent levels, and if you're lucky enough to own a home, we're recipients of healthy price appreciation. Thank you, and I look forward to your questions.
Hi, Jeremy Johnson with Doomberg. Watch a lot of YouTube videos, and I see that the housing market's on a precipice of a crash. Do you agree?
I second the notion that owning a home in this market appears unachievable, but the pace for home sales should increase this year from last. The key to housing is that the job market remains strong and inventory levels remain near all-time lows. While home prices do seem frothy, I do agree, it comes down to supply and demand, and right now, demand outstrips supply. Therefore, I think it's unlikely in this market and under these circumstances that a crash happens anytime soon. Certainly, limited availability of product is keeping prices high. It certainly remains a seller's market, but in that respect, who can afford to sell in this market? Next question.
Hi, this is Fernando Boni representing Diario de Navarra. Do you think the rates are high enough?
Well, I do think rates are high, but as far as high enough, I'd have to disagree because I think if people are still willing to pay between 7 and 8% for a mortgage, rates aren't high enough. Now, if the inventory levels increase and people stop paying 7%, then rates should go down. But the economy right now is way too hot, there's too many jobs, and inflation remains persistent. And higher interest rates are a function of inflation, and so are the home prices. But it's a be careful what you wish for scenario because when rates start to drop, it's likely for not good reasons. Does that answer that?
Chair Manny, this is Jim Harbison with the Villanovian. Did you see that the amount of adjustable rate mortgages has spiked recently to over 7% of total applications and that 40% of current homeowners say they wouldn't be able to afford their house if they had to purchase it in today's market. Any comment?
To answer back on the, was that article read on Redfin? Yes, yeah, I did see that. And to tell you the truth, I feel part of that 40%. If I had to buy equal house in this market and roll my equity over, my payment would nearly double if I was taking out, a 30-year fixed rate today. So yes, I would consider an ARM to help offset some of the cost. Absolutely. Do I agree that there's risk with the product? 100%. However, most of these ARMs are fixed for a minimum of 5 years, and you can get them even to the extent of 10, and some lenders will even do 15 years. So there is some protection, and to think that ARMs are on 30-year amortizations does give you some insulation. Now, if it was a 1-month ARM, like if you were borrowing money on a line of credit, I think you'd be putting yourself in harm's way, because who knows when the Fed will start to cut rates, and when they do, by how much. So I think it comes down to your appetite for risk, your game plans for the home. How long do you plan on keeping that home, and how long do you plan on keeping the loan? And as far as I'm aware, the max rate can go up maybe 1 or 2% per year. But I remember a time back in 2005 where I had an ARM up until 2010, and from 10 to 15, I got a cheaper rate, cheaper cost of funds each year as rates decline. So I do think that there is certain risk. Higher the risk on the adjustment period if it's monthly, or every 6 months as opposed to annually. But more important than the percentage of ARMs taken in this market, I think it's more important that the consumer has choices, and that's critical to a functioning housing market. Mhm.
Patricia Taps with fake news. Do you think that mortgage rates will ever return to the lows we experienced during the pandemic?
Yes, I do. I know it appears as if that ship has sailed, but I don't believe we're past the point of no return. If you just think of how much debt in the system, and the fact that we're in a debt-based economy, at the end of the day, it's one of two things: either the debt has to retreat, or interest rates have to. It's just one or the other. But what are we at? 34 trillion right now, and I think the only way that the show goes on is that if rates eventually continue to go lower. The tough part is no matter how you cut it, your purchasing power is the one that's going to suffer over time. And over the last 110 plus years, the average inflation rate is 3% per year. And prices today are over 30 times what they were 100 years ago. Did you know that the CPI in 1913 was a perfect 10? And today in 2024, it's 312? And do you think that's ever going to go down? It's only a matter of time until we have CPI 400. So you figure it out. Any more questions? Okay, then that concludes the meeting. Have a great day.